Thanks for your company for the weekly wrap. Well, the Aussie share market soared to a new all-time high this week as disappointing economic data proved the RBA will need to step in and cut rates, as we saw Australia's unemployment rate unexpectedly edge higher in January to 5.3%, and that's further away from where the RBA wanted. And this means the hunt for returns and yield will continue as expected. Meantime, we also saw Wall Street scale to record all-time highs as well, as Apple erased all of their coronavirus losses, while the Federal Reserve flagged it would hold rates steady as economic growth there was expected to continue, while it would keep a watchful eye on uncertainties around COVID-19 or coronavirus. Plus, we also saw China's central bank slash its loan rate by 0.1% to encourage growth, which is why we saw China's stock market almost erase all of its coronavirus losses. As for our central bank, well, we heard from them this week too. They said that growth would be weaker in the near term because of bushfires and the coronavirus. And this is why they revised employment to be lower in the first half of this year. But the RBA said a recovery from bushfires will add to growth in the second half of this year. All in all, for 2020, growth was maintained as per their previous estimates, and the RBA noted that growth will pick up this year and next year on the back of a couple of things: low interest rates, an uptick in mining investment, the housing market and consumption. And in terms of the big moves on the top 200 stock side of things, let's have a look at the best and worst performers. Well, Cleanaway Waste Management shares rose 17% on the week, Monday to Thursday, to $2.32, hitting a 6-month high after Australia's biggest waste management company delivered stronger than expected earnings, beating the company's expectations, with their revenue rising 4% to $1.2 billion, while CWY also announced full-year earnings will be stronger than the same time last year. And that's why we saw a bevy of brokers jump onto the company's wheelie bin, upgrading the stock, further fueling share price growth. And it's trading at a price to earnings ratio of 28 times earnings, which is above the industrial sector average. But JP Morgan and Citi reckon it's undervalued and is a buy. And in second place as the best performer is AMP, which rose 14% to $2.05. That's an 8-month high for the financial services giant. Well, despite the company reporting that $2.5 billion loss in the half year and also scrapping its dividend, it seems like this company could have turned a corner, leaving its issues behind it, particularly as asset sales should absorb future potential remediation costs or any negative surprises. And that's why we saw the company upgraded, with Bell Potter swinging the company from a sell to a buy. Capping gains this week was logistics software giant WiseTech Global, falling 26% to $18.80 after the company's profit came in below estimates, while WTC downgraded full-year guidance as China, which is critical to its global growth, has come to a standstill amid coronavirus. Bell Potter downgraded the stocks to a sell. Citi also downgraded the stock as well. And if you looked at our daily trading ideas on the day that WTC made that announcement, you could have seen our warning that it entered into a bear market, and you could have potentially avoided Thursday's 12% slide. And looking at some other big announcements this week, BHP's net profit after tax grew almost 40% to $5.2 billion for the half year, beating market expectations. BHP also maintained guidance and reduced costs for the full year. Welcome news. But the company did flag that if the coronavirus outbreak is not contained in the March quarter, it will have to drop its outlook for economic and commodity demand. The mining giant also noted the impact on demand could be permanent for oil, but temporary for copper and iron ore. as lost production could be reclaimed for those commodities in the future. The stock was also upgraded with a price target of $39, and on Thursday it closed at $38.52. Looking at Coles as well, their net profit after tax was announced, falling 34% in the half year to $489 million, with alcohol earnings falling. But the good news is that was better than expected in terms of the headline result. For the full year, profit forecasts were maintained despite the fires and the drought, as a turnaround in the second half is expected on the back of price inflation. Credit Suisse upgraded the stock with a 12-month price target of $17.72, implying that it is undervalued, as on Thursday it closed at $16.15. And looking ahead, economic news is quiet next week, but it's busy for reporting season, really ramping up on Wednesday. We're expecting to hear from A2 Milk, Afterpay, Rio Tinto, Virgin Australia as well. Woolies is also expected to report. They're the 9th biggest company on the ASX, so this will be closely watched. Their half-year net profit after tax is tipped to grow from $979 million to $1.04 billion. Staff underpayments from 2010. The payments are tipped to be around $200 to $300 million, and that will be written down as previously announced. But Woolies says that should be offset by earnings growth in food sales. But don't forget to tune in to our interview with the CFO of CSL, the second largest company on the ASX, as David Lamont dives into what's in the pipeline for one of the world's biggest health companies, and what to expect and why there's more upside. Thank you so much for your company. From all of us here at Bell Direct, have a happy and safe weekend. We'll see you next week. Bye for now.